So let us start looking at some chart examples. The next few videos, we will go through multiple charts. We will look at breakouts that have worked. We will look at breakouts that have not worked. We will also look at breakouts that worked, but it took a lot of time for stocks to go up. The stocks continued to consolidate even after going through the pivot point. And today's video is an example of that. Just because a stock breaks out of a base doesn't mean that it will quickly reach the target. It could take some time, maybe few weeks, few months, because we are dealing with weekly charts here. And the breakout could fail as well. So here is a chart of PNB, Punjab National Bank. And this is an old chart, 3rd of July 2023, that particular week. So as per the SEBI regulations, we have to look at old charts to do our study. That is why I am showing you old charts. So have a look at this base. And before you focus on the chart, I want to mention that you have to do the filtering, the shortlisting, and the stock selection. Okay, so let us assume that you have mastered that process by now. You know that first you have to filter stocks, shortlist them, and then select them. So assuming PNB is a stock that you filtered, shortlisted, and selected, and you did 5 kinds of analysis to do that process: liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis. Now you have decided that you want to take a position in this stock. Position size is a personal decision. Some people might want to put 5% of their portfolio in a stock. Some might want to put 10%. Some might want to put 20%. And assuming market conditions were okay during this time period. I have not checked by going back, but let's assume that that's the scenario, because we don't have past data, at least comparative data to look at. I thought let us look at charts on a standalone basis. The filtering, shortlisting, and stock selection you already know how to do. Okay. So if you look at this base, by the way, this was base number 2. So this is an early stage investable base in Punjab National Bank that came in July 2023. If we look at this pattern, it's a cup. Okay, it is not a cup with handle, because there is no handle here. So it's basically a cup. Okay, and that's the pivot point, the high of this candle, which is 62 rupees. So let us mark our blue zone, green zone, and red zone. I have my calculator here. Let's do the basics. And by the way, you have to do all of this the night before, like before Monday, because Monday the week begins. So 62 is the pivot point, right? So let us draw our zones. So I'll double click this. I will give it blue color. Coordinates. This will be 62, right? And this will be 5% above 62. So 62 multiplied by 1.05. 65.10. 65.10. See, that's the blue zone buying range. Then we draw another rectangle to draw our selling range. So this will be 20% above 62 rupees. So 62 multiplied by 1.20, 74.40. This will be 25% above the pivot point. So 62 rupees multiplied by 1.25, that's 77.50. Okay, and then we will change the color to green. Okay, so now as you can see, you have that green zone. So this is a 5% range. This is a 5% range. This is a logarithmic chart. Okay, and let's draw the stop loss range. So these are basics for a positional trader. You have to do this. Very, very simple process. Red color. Now this is 5% below the pivot point. So 62 multiplied by 0.95, that's 58.905, 58.90. This is 8% below the pivot point. So 62 multiplied by 0.92, 57.04, 57.04. That's it. You have the buying range, you have the selling range. Selling means partial selling range. You might not want to sell all of your shares uh, when the stock reaches here. As long as the fundamentals remain strong, market conditions remain strong, comparatively, the stock maintains leadership like good relative strength, good industry rank. You have to keep checking all of those. You have to keep doing that liquidity, comparative, technical, fundamental, and market analysis on an ongoing basis so that you assess where the stock is. If everything looks good, no need to sell all your shares. I mean, you can keep the stock as long as it remains above this blue line, which is the 10-week simple moving average. Another condition, by the way, the stock current closing price is between the pivot point and this blue line. Okay, so we want that price to be sandwiched between the two so that we can take a proper position. Look at the volume profile of this stock. Most of the times, whenever you have down weeks, they have come on low volume. What does that mean? That means accumulation. So, whenever there is low volume selling, which means it's not the institutions that are selling. So, the stock is under accumulation. This is base number 2. I checked that in Market Smith. So, when the stock enters that blue zone, that is when we plan to buy the stock. So, let's see how we would execute the trade. Now, here comes your analysis of volume. You have to look at these two numbers. Okay. So, Monday, Tuesday, Wednesday, Thursday, Friday, when you uh, check volume on a daily basis, you will understand whether the week is going to close on high volume or low volume. Okay. So, let's see what happens here. So, I click here. That would be Monday, right? The next week begins. This week is already closed. So, let's go to Monday. I click here. See that number has changed. Okay. So now you see the high of this candle is 62.35. The pivot point is 62 rupees, which means during the day, the stock spent some time in the blue zone. Okay. Which means you had an opportunity to buy. Whenever the stock enters the blue zone, you have an opportunity to buy. And chances are very good that you must have bought some shares or you should have bought some shares. Why? Because number one, the stock enters the blue zone. So you might want to put alert here. So the moment the stock hits 62 rupees, you are alerted that, okay, now it is time to check volume and buy at least some shares. So no matter what your position size, let's say you decide to buy, for example, 100 shares. In such situation, I would pick up at least 50 shares. Why? Because I want to buy gradually. Okay. As per William O'Neill's advanced CAN-SLIM system, the ideal way to buy a stock in the blue zone is first you buy 50 shares, then you buy 30 shares, and then you buy 20 shares. So you gradually add to your position while you keep an eye on volume. Why do you do this? Because once you buy the first 50 shares, you want to see volume and price action follow through. If you buy shares and the volume begins to fall or the price begins to fall, then you might not want to buy the remaining half because you are naturally controlling your risk. So, assuming that we buy 50 shares, okay, and then the price, see, it comes down. Why would you buy? Because the volume has been very good during the day, right? See, 100 million volume and the average weekly volume is 202 million. So, half of the entire weekly volume has come in a single day, that is on Monday, which means if let's say we go at this rate, say like 100 million volume every day for the next 5 days, that the week would close at 500 million volume. And what's the average? It's a roughly 200 million. So, which means the week would close, we are extrapolating volume here. The week would close at more than twice the average weekly volume. That is very good, right? That is why there is a case to buy some shares at least, not all, but some shares. And when the price comes down, okay, it does not, uh, the case to buy the stock becomes weaker. So we don't add another 50 shares just to control risk. Okay. So assuming you buy here, your stop loss would be 8% below the your average execution price. So let's say your average execution price is you buy at the high, okay, 62.35. So let's draw that line. So I will give this 62.35. That would be blue color here. So let's say that's your average execution price, which you get from your broker. Your broker is the only person that will give you the average execution price. It falls within the blue zone. Okay. Then you put the stop loss 8% below 62.35. So 62.35 multiplied by 0.92, that is 57.36. So 57.36, this is red color. 57.36. Yeah, so the blue line is the average execution price, the price at which you bought the stock. The red line is your 8% stop loss. This green, blue, and red zone, the shaded areas, don't play around with them because they are fixed based on the pivot point. Okay. What is not fixed is your average execution price and your stop loss. Now, the stop loss thankfully falls in that range because the price itself falls within that buying range. Okay. And our target would be 25% above this blue line. So 62.35 multiplied by 1.25, that is 77.93. So 77.93. So that would be your target. So let us move forward. So this is Tuesday, nothing happened. Then Wednesday, again, nothing happened. Thursday, see, Thursday, it enters the red zone. It never touches your stop loss, but it does enter the red zone. Okay. Which means what? You have to start reducing your position size. Okay. On high volume, if the stock begins to come down, which means you have to start cutting your position size. So let's say out of 50 shares, by this time you sold 25 shares. Okay. So you still have 25 shares remaining. Your original plan was to buy 100 shares. You now have 25 shares, thinking that, okay, it has entered the red zone, but chances are it might go up. Okay. Let's see what happens. Again, it pulls back, okay, comes above the red zone, which is a good sign. So that week is over. So next week begins. Now the stock enters the blue zone. Now here comes the question, should you buy or should you not buy? Should you buy back those shares that you sold, the 25 shares, when the stock came here? Well, that depends on there is no hard and fast rule here. That depends on your risk appetite. Now that the stock is again entering that buying range, a person who wants to take risk, okay, because now the stock has pulled back after falling down, a person who wants to trade aggressively might want to buy back those 25 shares, okay, because the stock has pulled back. And you can see that movement on the daily chart and see the bar closed as green color on high volume. That's a good sign. Okay. So for an aggressive positional trader, you might want to buy back those 25 shares, okay, and keep your stop loss at the same place. For a conservative positional trader, somebody like me, I wouldn't buy back the shares. I will just keep the remaining 25 because I want those 25 shares for me to make money. Because if those 25 shares don't make me money, how will I recover the money that I lost on these 25 shares, which I sold, ended up selling at 5% loss roughly, correct? So I want the stock to prove itself. So I wouldn't bother buying additional shares. I might keep an eye on the volume, but I am a conservative trader. Okay, that's my personality. So if a if I have lost money on a stock, I wouldn't buy more of the stock, basically. Okay. However, I am flexible as well. If in my previous 3, 4 trades, if I have made good money, then I might want to buy this stock because I have money to finance the risk that I am taking additionally here. So it is all subjective. Okay. The entire system and the strategy remains the same. What changes is your tactics as on the daily and the weekly time frame chart. Okay. Rest everything remains the same. The selection, the filtering, the shortlisting, and things like that. So this much explanation is enough as far as trade execution is concerned. Now I will move the price several weeks forward. Okay. I am assuming you will understand how to look at volume. Don't go to the daily chart. Keep your focus on the weekly. See, now the price begins to move up. Let's see what happens. See, it comes back to that red zone. Okay, which means what? You would end up selling again another half of your remaining shares. So if I have got 25 shares, okay, let's assume I did not buy extra here. Out of 25, when the stock again comes back here, I would sell another half. Okay, because I don't want to book 8% loss. Okay, so whenever the stock enters this zone, I might want to reduce my position size to control my risk. Okay, so out of 100, initially I bought 50. Then it came down here, I sold 25. Now I have 25 shares. Out of 25, again sold half, which is let's say 12 shares. Now I have 13 shares left. Okay. So I move the price forward. Now the stock begins to make a move. See how it keeps above the 10-week simple moving average. You have to wait several weeks and the stock enters the. So those 13 shares which I still have, those 13 shares make money, probably compensating for the loss that I incurred on the other shares. Okay. That is how you would approach the stock. If you notice, after this bar, there are three consecutive bars which are below the high of this candle, which means before even the stock reaches the target, it forms another base. Okay. So this base is called base number 2. So we will call this base number 2A. In Market Smith, it would be written as stage 2A. That's nothing but base 2A. And then this pivot point, the high of this candle becomes the pivot point 65.15 because there are three consecutive candles closing below that high. So that's a three-week consolidation. And then this candle becomes the actual buying candle. Sorry, this bar becomes the actual breakout bar, although it comes on low volume. But this base would be called as a flat base, base number 2B. This base would be called as a cup base without handle, base number 2A. 2A and 2B. We are dividing base 2 into A, B, C because the stock has not reached the target. So if you take the high of this candle as the pivot point, your blue zone, your red zone, and your green zone will shift upwards. Okay. That is how you would approach the trade. So as you can see, if you just read, if you just keep an eye on the red zone, if you just keep an eye on price and volume, that is more than enough. You don't need to go to the daily time frame chart or intraday time frame charts like weekly, 15-minute or 5-minute. So positional trading on the weekly chart is fairly simple. It is more like investing. Okay. You spend a lot of time with the stock when it comes to positional trading. Okay. And you set alerts. So one alert could be when the stock enters the blue zone. So 62 rupees would be the alert. Another alert would be when the stock enters the red zone. So what is that red zone? It is 58.90, I think. Yeah, that would be another alert when the stock enters that zone. You would want to be alerted and you would want to take some action. So not much thinking to do here. It is basic. It is common sense. Okay. You don't need to switch between monthly and the weekly and the daily. Just learn to read price and volume and learn to understand the colors. Okay. Green color means higher closing than the previous week. Okay. Previous week closing. Green color means higher closing compared to previous week closing. And the color of the price bar matches the color of the volume bar. That's it. When the color is red, we want the volume to be below that 10-week simple moving average on the volume. And when the color is green, we want that volume to be generally above the blue color line on the volume chart. Okay, it's very simple, nothing complicated here. We are not using any indicators here, no MACD, no stochastics, no RSI, no Bollinger Bands, no Ichimoku. There's hardly anything, there's hardly any moving averages here. So basically, the entire process relies on three key processes, which is filtering, shortlisting, and selection. After that, it is more or less trade execution and trade management, and of course, risk management, position sizing. After that, you don't rely too much on the chart. Let the stock do its own thing, because the fact that it's a positional trade, which means it came through your fundamental criteria. If the stock is doing well fundamentally, in most probability, the stock price should follow through. Okay, in most cases. Sometimes it doesn't, but because that's the nature of the market. Anything could happen in the market. Market conditions could weigh on the stock. But when you look at price movement like this, price continues to remain above the an aggressive weekly chart positional trader has a very good opportunity to capture this. Okay, in a very short period of time. This is like 2-3 months of price action, correct? 2-3 months of price action, 20 to 25% return approximately. That's a decent way to earn money from the market. Okay, we are not looking at daily fluctuations here. Some of you might want to trade stocks aggressively, so you might just want to buy, let's say the price enters the blue zone, you might just want to buy, let's say, all 100 shares, keep your stop loss, and then forget about the stock for the next 2-3 months. As you can see, the stock never touched the stop loss. See, the stop loss was at 8%, right? Which is a standard which is recommended by William O'Neill in his book 7 to 8%. Even Mark Minervini talks about 8% stop loss. So if you are an aggressive trader, positional stock trader on the weekly chart, all you have to do is just buy here 100 shares, fill up your position size, whatever you planned in the blue zone, keep your 8% stop loss, and just forget about it. It will either hit your stop loss or it will hit your target. In this case, it hit your target within a few weeks, right? Maybe 2-3 months. That's it. Very simple. It's just plug and play, set and forget kind of a thing. You could choose to do that as well. There is no micromanagement involved there. What you could do during that time period is that you keep an eye on market conditions. You keep an eye on the fundamentals of the stock, maybe quarterly report or things like that. And you would keep an eye on price and volume. Okay, that's it. You don't have to micromanage the trade because you are a positional trader, correct? So that would be an aggressive approach. A conservative approach is what I have illustrated uh, in this video. Okay, if you have any doubts, questions, clarifications, please send me an email or write in the comments section. Preferably send me an email. Okay, that would be better because I reply. I continuously keep replying on my email. Sometimes I reply with a voice message, but send me a proper email. Okay, so that we can discuss such kind of situations. I hope this video has been helpful. I hope you are liking this video series because positional trading has been made simple by William O'Neill many decades ago. This system that I'm discussing with you, William O'Neill was using this system in the 60s and the 70s. So it's decades old system. It's basics. Okay, no indicators. During those times, there are hardly any indicators, and the system worked. Okay, the key here is filtering, shortlisting, and selection. If your selection itself is flawed, like right, if you're buying illiquid stocks, you will lose money. If you're buying technically weak stocks, you will lose money. You're buying fundamentally weak stocks, you will lose money in the long run. Correct? If you're buying stocks when the market conditions are weak, when 3 out of 4 stocks are falling, you will lose money, right? When all the ducks line up in a row, only then you enter. It is not mandatory to put money in the stock market. Just because you have come to the market with some money doesn't mean that you have to buy a stock. It is not mandatory. It is a choice. Participating in the stock market is a choice. A lot of people spend their entire life not buying a single share in the stock market ever, and they are happy. Okay. So Putting your money in the stock market is not mandatory. You are making a choice, and that better be a very positive, calculated choice. Okay. We will look at another chart example in the next video. Thank you so much.